Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And this week, I am delighted to be joined by Leah Bramwell from our Chief Investment Office. Morning.
Morning. Thank you for having me again, Jane.
Lovely to see you. So as you know, each week we try to cut through all the noise that's going on in the markets. This week, the noise, we've just been talking about local elections, but we're trying not to stray into that territory. Demystifying what's going on in a simple and easy to understand manner. And hopefully then you can feel more informed, more confident, and more in control of your financial future. So this week, Leah, I really wanted to talk to you about two of the market's traditional safe havens, which seem to be behaving very differently and not in the way we would normally expect. In the past few weeks, we've been talking about AI and the Magnificent Seven in the US driving markets. But I think it'd be more interesting for our listeners to hear a little bit more that's a bit less obvious maybe about what's happening. So grab your coffee, let's dive on in and let's see what's going on behind those headlines. So as I mentioned, markets are still being driven by AI and tech, but we want to look beyond that this week to something more subtle and arguably more important is happening in the so-called safe parts of the market. So could you just briefly give us an intro as to what we're talking about here?
Absolutely. So I'm sure we'll come back to AI because it's
I'm sure we
driving
will.
lots of things at the moment. But I wanted this week really to touch upon a couple of other sectors and thematics that I think have some really interesting dynamics going on at the moment. So that would be infrastructure and precious metals and associated mining stocks.
Okay, so should we have a little look into infrastructure first? So what's the story there? What's happening?
Absolutely. So infrastructure historically has been viewed as a fairly defensive sector. It's got a very high allocation to utilities, more defensive parts of the market, which are typically regulated, typically have significant elements of inflation linking within their cash flows.
So how does that work?
The underlying cash flows of the business would be linked to inflation. So if inflation is higher, the revenues of the business automatically go up because those cash flows are contractually linked often to governments with inflation. And so they often are viewed as a safe haven. In times of market stress, those types of assets tend to be more defensive than the wider market. And it's been a really interesting area over the last 18 months because it has evolved away from being a purely sort of defensive play, steady eddy in times of stress, to being linked to some of the spend that we're seeing in the AI build out. So the electrification of economies and the energy that's required to build out that AI capacity has been benefiting these traditionally more defensive names.
So the AI story feeding into infrastructure.
Exactly. And so you're having exposure to that theme without some of the froth and the hype of the technology names, and certainly without the valuations associated with those names. But you're having exposure to that CapEx in a still a more defensive way.
CapEx being capital expenditure.
Exactly.
And what those AI tech companies are investing in to drive that AI growth agenda.
The sort of the plumbing, the nuts and bolts of
not the sexy
required.
bit.
Not the sexy bit, but the bit that is required in order to make it happen.
Okay. And so the other safe haven sector you mentioned is precious metals and mining. So what, gold, silver?
Yeah, so mining not typically a safe haven, but gold in itself traditionally viewed as a safe haven asset. So where you have geopolitical instability, where you have very uncertain inflationary environment, gold historically has been attractive during those times. And we've seen really interesting market dynamics in gold again over the last 18 months. So a huge rally in the price of gold and silver and other precious metals in 2025 and at the beginning of 2026. And we spoke, I think, last time as the US-Iran conflict was kicking off, that one would have expected that precious metals would have behaved positively in that environment. But in fact, we saw inflation concerns in the markets leading to an adjustment in expectations for interest rates, which hurt the price of gold rather than having an increase in the price of gold.
Okay, right, you might need to explain that to me. So the reason why high inflation can impact the price of gold, explain that a little bit more.
So usually inflation is viewed as positive for the gold price, inflation in itself, because gold is a store of value.
Yeah.
But where you have expectations for interest rates going up, that's negative for gold, because if interest rates are higher, your opportunity cost of holding gold, i.e. what you would get if you were choosing something else, cash in a bank or a bond, you get a higher return from that than you do from gold. Gold doesn't pay any interest. You're not getting anything from holding gold. And so if your interest rate on cash goes up, you're more inclined to go for that because you're getting a better return relative to gold. So there's quite a lot to unpick. And it's not exactly clear always what the drivers of the gold price are, but really a sort of stagflationary environment, that is low growth, high inflation. Low growth, so central banks are not inclined to increase interest rates, but still high inflation is viewed as the ideal environment for gold. And arguably that's been where we have been, or the concerns over that's where we're going over the last year has impacted the price of gold over the last year.
Interesting times. So what you're saying is one traditional safe haven is behaving exactly like you'd expect, which is infrastructure, whereas the other one isn't, which is gold.
Yeah, so what I'm saying really is that one might expect both of these asset classes to behave in the same way. In the environment that we're in. So one might expect in an environment where inflation is relatively higher and sticky, and interest rates remain relatively contained, one might expect that to be a good environment for both infrastructure and for gold. And for 2025, that absolutely was the case. Infrastructure, utilities were one of the top performing sectors in 2025. And gold, obviously and gold mining equities as well, which tend to correlate, were exceptional in 2025. So that story played out. But year to date in 2026, they've sort of diverged. And I think that's really interesting because infrastructure is now very much being linked to that AI spend, that AI theme. And gold, having had such a huge run and perhaps some speculative activity in that market as well, has given back all of its gains from the beginning of the year and is now trading sort of roughly in line with where we started the year.
Is there anything else beyond the sort of the AI capex that could be influencing the infrastructure situation?
I think infrastructure probably has become more onto people's radar. Infrastructure was hit very, very hard as interest rates went up in 2022, because I think a lot of investors were using infrastructure as an alternative to fixed income.
How does that work then?
Infrastructure pays a good yield. And so when interest rates were basically zero, before we saw this latest cycle of tightening, people were using infrastructure to provide yield within portfolios. And then when interest rates started going up, infrastructure was hit very hard by that, certain parts of the market. And so I think the infrastructure was really out of favour for quite a while. Certainly a couple of years, it was really a difficult place to be. And I think now that that's started to turn around, there's a lot of positivity more in the sector than there was even this time last year.
And I guess there are a lot of power grids, data centres and energy infrastructure required to run all that AI that we're starting to see coming through.
Yes, exactly. And I mean, there is infrastructure spend, I think, above and beyond that as well. Certainly in Europe, that some of the fiscal environment has improved, I think, for infrastructure. I think certain governments are looking to spend in ways that they haven't been over the last 10-15 years in terms of sort of improving the infrastructure environment. So it's not just an AI story. I think that it goes beyond that, but I think the prospects for the sector look good.
Good, thank you. It's probably a good time to sum up what is in my Canaccord takeaway coffee cup today. I think we've said that not all safe havens are safe. So investors should probably look at the fundamentals, not just the assumptions and the headlines, to make sure that they're considering thematic differences underneath the surface, sort of thing. And that this extends beyond the tech AI story, while traditional safe havens like gold perhaps are not behaving in the same way. And demonstrates, as we say most weeks, the importance of active selection, close monitoring within portfolio.
Exactly right. I think it's really important to recognise that there's lots of stories going on in the markets, and there's lots of complementary stories. And to be active and to be proactive in making sure that your portfolios reflect those things.
Thank you. And thank you very much for listening to the Canaccord Coffee Break podcast today. I hope you've enjoyed it. Don't forget to hit follow Spotify, Apple, or your podcast channel of choice so you never miss an episode. And as always, we'd love to hear your thoughts. Do drop us an email, coffeebreak@canaccord.com. Thank you.
Thanks, Jane.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.